In this episode, we'll cover what LVR is and how it's calculated, why it matters so much to lenders, how LVR changes over time, and how to use it strategically to build flexibility and long-term financial strength for your situation. So let's jump in. Hello, and welcome to First Home Unlocked, the podcast for unlocking clarity and confidence for first home buyers. I'm Jack Elliott, National First Home Buyer Specialist at Alcove.
And I'm Chris Bates, ex-financial planner and mortgage broker.
Together, we are on a mission to empower you with the keys to unlock your first home. Let's jump in. Hello and welcome back to First Home Unlocked, another episode in our Finance 101 series where we unpack the key parts of your mortgage so you can understand how everything really works behind the scenes. Chris, I'm loving having you back in the studio. How are you?
Oh, I'm doing well, Jack. I mean, I'm not sure exactly when this is going live, but super excited. My boy turns 4 this weekend and we're getting to the golden years, they call it, as parents, when the 2 kids get in that sort of 4 to 10 range. So yeah, we've got through the trenches, they call it, as parents. Super excited for his birthday this weekend. What's news with you?
This weekend I'm going back home up to Echuca for one of my good mates' 30th birthday. So that's the first 30th that I'm going to. So I'm getting into that range of age group now. So yeah, excited to go back there and spend some time with some friends and people that I haven't seen for a while. So that's what's on the cards for me. Now, today, getting back to this episode, we're unlocking a concept that sits quietly behind almost every lending decision, your loan to value ratio or your LVR. Now, it's one of those terms you'll hear a lot when you're applying for a loan, but not everyone understands how it actually impacts your interest rate, your approval, or even how much flexibility can open up for you in the future. So in this episode, we'll cover what LVR is and how it's calculated, why it matters so much to lenders, how LVR changes over time, and how to use it strategically to build flexibility and long-term financial strength for your situation. So let's jump in. Now, your loan to value ratio measures how much of the property value is owned to the bank. It's calculated using a simple formula. So your LVR, or your loan to value ratio, equals the loan amount divided by the property value times by 100. So if you buy a property for $800,000 and you borrow $640,000, your LVR is 80%. So your LVR tells the lender how much risk they're taking on, and it determines 4 key things. The first is whether lender's mortgage insurance or LMI applies. Second is the interest rate you'll be offered. The third is how flexible or strict the bank can be with your application. And the fourth and final one is how much usable equity you'll have later to refinance, renovate, or invest. So from a bank's point of view, the higher the LVR, the higher the risk. That's because the borrower has less equity in the property and less buffers if prices fall or income changes. So the general rule of thumb is 80% or below is considered low risk, above 80% is considered higher risk and often triggers lender's mortgage insurance or LMI. Now, this is where the well-known 20% deposit idea comes from. It keeps your LVR at or below 80% and removes the need for lenders at mortgage insurance. But remember, this would be a 20% deposit plus the upfront costs. Now, Chris, we know this has led to many people thinking they need to save a 20% deposit to buy their first home, but there are a lot of other options for first home buyers. We'll touch on the 5% deposit scheme in a moment, but what other options are there for first home buyers out there?
Look, I think it's all changed in recent years with the 5% deposit scheme. It really has expanded the options for first home buyers. If that wasn't around, I think a lot of people, first home buyers, would think, oh, we need a 20% deposit, and they misunderstand lenders' mortgage insurance. And often people would try to save for that 20% deposit. For years, we would try to educate clients on how lenders' mortgage insurance would work and the benefits of using it, but also the ways to minimize it and get the best advantage of it. I mean, lenders' mortgage insurance waivers was something we always considered for clients, but it's only for certain professions, whether in doctors or accounting or lawyers. And it has expanded over the years and include like nurses and etc. So depending on the profession you have as well, you definitely want to know whether you're eligible for any LMI waivers. And we have seen an explosion of sort of new low deposit type of lending that has come in recent years. There's always been a bit of innovation here where people say, oh, could I provide an alternative to lenders' mortgage insurance? Some Some banks have offered like 85% no LMI. I mean, even a bank's just come out recently offering 90% no LMI for lenders. And we've even seen 95% LMI loans before with like very small non-banks. And so this is where a great broker will always look at, okay, your alternative option. But for first home buyers, which we're talking about on this podcast, the real expansion of the 5% deposit scheme since October 1 has really made that basically include almost anyone if you're a first home buyer.
So you're right, that first home guarantee scheme is the main option first home buyers will have available, but for other buyers around, there are different options that we can consider. And like you said, a broker will be able to talk you through all them things that are available and all them waivers and certain policies and compare everything for you. Now, most banks also price their loans in tiers, which means they apply different interest rates depending on your loan to value ratio. So for example, if you had a LVR under 60%, you can access the lowest rates on the market. Now, if you had an LVR between 60 and 80%, you get access to standard competitive rates. And if your LVR is 80% or above and you aren't eligible to use that first home guarantee scheme, you are usually looking at higher rate and tighter rules as that loan to value ratio increases. So it's not just about the rate. Now, another really important part of understanding LVR is how it shapes the bank's lending policy, because your LVR doesn't just influence your interest rate, it also affects how flexible the bank can be when assessing your application. So the simple rule is this: the lower LVR equals lower risk and more flexibility. The higher the LVR, the higher the risk and the tighter rules and less discretion. So when you're under 80% loan to value ratio, lenders often have a lot more room to move. They can make exceptions, accept different types of income, and apply a bit more common sense when looking at your situation. But once you go above that 80%, especially toward the 90-95%, the bank has to be much more conservative. Every part of the application gets looked at more closely. Here's what it looks like when your LVR is under 80%. Over time, allowances and bonuses are more readily acceptable as usable income. Your probationary employment is often fine under 80%, but some lenders won't accept it at higher loan-to-value ratios. You've got self-employed borrowers may be eligible to use simplified income methods, like relying on personal income rather than the full business financials, but usually only below that 80%. And there's policy exceptions like we talked about, like a shorter employment history, past credit issues, or unique scenarios are much easier to get approved when your LVR is lower. Now, it all comes back to risk. A borrower with lower loan-to-value ratio has more equity behind them, so the bank has a stronger buffer if anything goes wrong. Chris, have you seen lenders look more closely at an application when clients are borrowing at a higher LVR?
Absolutely. It does go through different sort of credit teams, and there was different risk ratings. Banks are much more likely to approve lower LVRs, much simpler, particularly when we've got to ask for things like policy exceptions, when people are relying on commission incomes and bonuses, or it's a business. It does bring in obviously another element of risk to the bank, and particularly when they have to pay lenders mortgage insurance, because they're not just satisfying the bank's policy, there's also a mortgage insurance off to the side that they have to satisfy. And so obviously a lower LVR loan is lower risk and will have a lower amount of credit assessment.
Yeah, you're right. And that's a good thing to also bring up, Chris, is that the bank, when you go over that 80%, you're paying lenders mortgage insurance. Yes, they've got their risk to also be aware of, but they're also applying externally for that LMI protection from another provider. So they've also got to get that across the line with that provider to give them that LMI. So that's something that's really interesting and something to consider when you're looking at that higher LVR as well. Now, if you are buying under the first home guarantee scheme, like we spoke about, also known as the 5% deposit scheme, your LVR works a little differently. So under this scheme, the government acts as a partial guarantor for up to 15% of the property's value. And that means your lender can treat your loan as if it was an 80% loan to value ratio for lenders' mortgage insurance purposes, even though your LVR is actually 95% if you max out that scheme. So you avoid lenders' mortgage insurance and you get access to the same sharper rates and policy flexibility that someone with a 20% deposit would normally receive. Now, Chris, for buyers using the first home guarantee, how do you help them think about the balance between getting in sooner and managing the risks that come with a higher LVR?
Look, I do think a lot of people that are buying property or going out there, and it's a huge financial decision, are really weighing that up. Obviously, a lot of people that think that the first-time buyers are going to over leverage and they're going to have these huge mortgages they can't pay and then they're going to default. That's just not giving enough credit, I think, to the next generation of people actually going out and buying homes. What you really want to do, though, is understand what is going to be your monthly repayment and really understanding your personal cash flow and your personal income, how that's likely to change over the coming years, and being really clear to go, you know what, as long as I keep earning this income, which is highly likely based on what I do, and I'm hopefully going to get a pay rise next year, or I'm going to switch jobs or whatever it might be, everyone's got an individual situation. So it's just really being real around your income and then being really conscious around your actual spending. Don't just put your finger to the sky. Go back and look at your spending over the last 12 months and say, what could you cut back and what couldn't you cut back? And I think it's really just being real around that as well. I mean, I think everyone makes lifestyle changes when they buy property. Your priorities shift, right? You've now got an asset that you need to pay off. And yes, if that means that you've got to be a little bit wiser when you go out and spend money, you go on less holidays, then you're probably going to be willing to make that sacrifice. And I think what you'll see is if you look at people defaulting on home loans in first home buyers and arrears rates with first home buyers, it's not really the reality. Most of first home buyers get their property and they do everything they can to keep it. Often you need to also protect yourself if repayments are going to go up. And so you do need to be conscious of that, but it really depends on the market cycle. At some points in the market, rates are very unlikely to go up, and sometimes they're more likely to go up, i.e. when they're very, very low and, like it was back in 21, 22. And so that's another thing. The only thing I'd also make, when you're buying property, there's additional costs that come. And so you definitely want to not know that you can afford those, whether it's strata, whether it's insurance, whether it's maintenance, whether it's just council rates and taxes. Like, just be conscious of that and don't forget about them. And then the biggest thing to protect yourself, whether you buy a house, is just making sure you haven't got any major repairs you have to do. So you're doing a really good building and pest. If it's buying an apartment, just really be conscious around the strata and the sinking fund and making sure that's not going to jump on you. That really just protects you.
That's right, Chris. And it is. It's about going back to what's going to suit your lifestyle repayment-wise, looking at your budget. And the second thing is that talk around arrears rates being high. As we mentioned in a few episodes ago off the back of the new First Home Guarantee Scheme report, it actually showed that arrears rates when people using the scheme was actually lower than the national average. So it just shows that people are making their repayments when using the First Home Guarantee Scheme. So moving on, if you are borrowing at that 95% loan to value ratio, it isn't a bad thing. The scheme exists to help first home buyers into the market sooner, but it does come with that more responsibility like we're talking about. And when you start with less equity, you have less flexibility to refinance or access that equity in the short term. So that's why we always encourage having buffers in place to start with, something that gives you breathing room if things change. Now, your buffer might look different depending on your lifestyle and your comfort level. For some people, it's 3 to 6 months of mortgage repayments. For others, it's a savings target, maybe 10,000 or 20,000 kept in that offset account. Or it might be having income protection or other insurances for peace of mind. So there's no one size that fits all number here. It's about what helps you sleep at night. So you'll want to think ahead and how to protect yourself if interest rates rise, your income changes, or your property value dips for a while. Would you agree with that, Chris?
Yeah, absolutely. Best to get prepared, be ahead of it, and really understand your repayments.
Now, as you pay down your loan and your property value changes, your LVR changes too. Every repayment you make and every bit of market growth helps reduce your LVR and build your equity. Now, equity is simply the portion of your home that you actually own. It's the difference between what your property is worth and what you still owe the bank. Now, usable equity is the part of your property's value that you can actually tap into. It's usually calculated as 80% of your home's current value minus your remaining loan balance. That's the amount the bank is comfortable letting you borrow for things like renovations, investing, or buying your next property. So here's a quick formula to work out your usable equity. So you've got your property value times 80%, take away your current loan balance. Now let's look at an example. If your property was say worth $800,000, 80% of that is $640,000. And if your current loan balance is $500,000, you've built $140,000 in usable equity. Chris, this is where asset quality discussions again is so important, right?
Yeah, so I think with a lot of first home buyers, they obviously want to buy. There's a lot of pressure on them to sort of take action. And sometimes, not saying always, they might rush the decision and just try to tick the box, get the asset, get a property rather than focus on the asset quality. But one of the things, particularly when you're going for a 5% deposit, is you want to try to build some equity. And the way to do that is the property value going up, not so much your loan getting paid off. I mean, yes, absolutely, that builds equity, but that's just saving. What you want to do is your asset working for you as well. So in this scenario, for example, if your property does increase, then potentially you could refinance refinance that to another mortgage when it gets under 80%. Maybe that could release the equity. Then maybe you might spend that on a renovation, or you might do further investing, etc. Or maybe you might even just go, well, this property's worked for me now. I've got enough equity to then go and upgrade. Maybe I was a single, now I'm in a couple, and now I can use that equity and upgrade to a house that you're going to live in long term. And so absolutely, you always got to be thinking for first home buyers is not what suits me today, but what's actually going to help me for my future and actually getting a good asset.
Exactly right, Chris. And that asset that's growing for you just gives you more options and that stronger long-term security when you've got that equity that's growing for you in that asset that you've brought. Now that you understand what LVR is and how it changes over time, let's talk about how you can actually use it to your advantage. Now, the first thing is to keep an eye on it. As you pay down your loan or your property value increases, your LVR naturally improves. So it's worth checking in every so often. Now, once that happens, you've got options. You might be able to negotiate a sharper rate with your current lender or look at refinancing to a more flexible product that better suits your goals. Next thing to think about is your bigger picture. As your equity builds, it can give you more ability to renovate, invest, or simply create more breathing room in your finances. And like we mentioned, Chris, if you're brought using the first home guarantee, one of the best long-term goals is to refinance out of the scheme once your LVR reaches around 80%. That's when you can regain full flexibility without relying on the government guarantee. And like we mentioned, your LVR is shaped not only by how you manage your loan, but by the quality of the asset that you buy. A well-chosen property is more likely to grow in value over time, helping your LVR improve naturally. Now, if you haven't already listened to episode 6, Unlocking Asset Quality, I highly recommend going back to that one for a clear framework on how to assess long-term growth potential. And at the end of the day, understanding your LVR isn't about chasing the lowest number possible. It's about knowing that one ratio affects your options, your confidence, and your next move. Chris, once someone's brought their first home, what's the smartest way to approach reviewing their LVR? How often should they be checking in, and what kind of milestones should they be looking out for?
Look, I think this is very natural to, as soon as you purchase, to want to know that you've got yourself a good deal, to make sure that the property goes up. It's like when people buy money in shares, it's so natural to be tracking it. Human nature is just to constantly be reviewing it. The reality is, unless you're looking to sell, does it really matter? So, obviously every 6 to 12 months, you want to sort of just have a quick squeeze on Domain and real estate and look at sold properties and potentially go to an auction of a similar property if you've got one in the market, and just so you can get a sense of the feeling of the market. But it really depends on an individual. Probably the less you do it, the better, to be honest. But at least once a year, just do a check-in. We send property reports to our clients when we're doing pricing for them. Often that also allows us to go, oh, actually, that's jumped a little bit. Actually, compared to the loan, oh, the LVR's gone down. Maybe we can get a better pricing for this customer. And so that's one of the benefits of doing it. But also, if there is a sharp movement in prices, because sometimes you do have a property that could really run quite fast, and then you go, well, actually, that's just created an opportunity for me. It doesn't have to be a huge amount, but it might just be an amount that it increases, that it releases some equity for you. So yeah, definitely stay on it, but don't be tracking it every week. You might send yourself a little bit insane. And just remember, every property sells under different circumstances. It doesn't mean that was the price of the property. So sometimes you can get disheartened because you see a property and you go, God, I can't believe that sold for 800. It was better than mine. And you might go, that was a fire sale. It was maybe had issues with the sinking fund. Sometimes there's issues that you just don't know why a property sold for a certain price. So don't get too fixated on one property sale as well. Look at a broad number to give you a bit more confidence.
Yeah, that's some good tips there, Chris, as well, not to get too caught up on it, and check in with your broker as well. Good brokers like we do will review that every 6 to 12 months, make sure you're on the best rate. We can check in and do some valuations and see where that property movement has come. And like you said, send through property reports as well. To recap today, your LVR shows how much of your property is owned by you versus the bank. It directly influences your interest rate, lender policy, and access to equity. Keeping your LVR lower gives you more flexibility and better pricing. And even if you start high, say at 95% under the first home guarantee scheme, you can strengthen your position over time through consistent repayments, smart use of your offset. And if you'd like help structuring a strategy for your next move, whether it's buying your first home or planning your next step, you can book a get to know you chat with me at firsthomeunlocked.com.au/book. Chris, any final thoughts for buyers who are trying to wrap their head around LVR for the first time?
Oh, I think we covered a lot, Jack. I really enjoyed doing the episode with you and look forward to our chat already next week.
Thank you so much for listening. We'd really appreciate if you could do us a huge favor. Share this episode with any first home buyers that you know so we can help more people like you feel clear, calm and confident when purchasing their first property. You can join our Facebook group, First Home Unlocked, to continue the conversation with other first home buyers. Or if you're ready to unlock your first home, you can book a get to know you chat by using the link in the show notes or by going to firsthomeunlocked.com.au. Before we go, just a reminder that everything we share on this podcast is general in nature and not tailored to your personal situation. We always recommend seeking advice from a qualified and experienced professional when making financial decisions.